Hey everyone! Welcome back to Stock and Crypto World with VJ. Today, we're diving into a hot topic that has been making headlines worldwide: China's economic slowdown and what it could mean for global markets and your investments. Before we jump in, a quick reminder: this video is for informational purposes only and does not constitute financial advice. Always do your own research before making any investment decisions. Let's get started! China's economic slowdown. What's happening? China, the world's second-largest economy, has been experiencing a notable economic slowdown recently. Various factors are contributing to this, such as weakening exports, a decline in consumer spending, and a significant real estate crisis. Just last week, the Chinese government reported a lower-than-expected GDP growth rate for the second quarter, which sent shockwaves through global markets. Why is this important for global investors? You might be wondering why a slowdown in China is such a big deal. Well, China plays a massive role in the global supply chain and is a major consumer of commodities. A slowdown in the Chinese economy can lead to a ripple effect across the globe, affecting everything from tech stocks to commodities like oil and metals. For instance, major companies that rely on Chinese manufacturing, like Apple and Tesla, could face production delays and higher costs. Similarly, countries that export raw materials to China, such as Australia and Brazil, might see a decrease in demand, which could hurt their economies. The impact on stock markets. We've already seen global stock markets react to this news. The Shanghai Composite Index has been under pressure, and we've also seen declines in the Dow Jones and S&P 500, particularly in sectors heavily exposed to China, like technology and industrials. Investors are nervous, and this sentiment is reflected in the volatility we're seeing in the markets. However, it's not all doom and gloom. A slowdown in China could also present some buying opportunities, especially if you're looking at companies that have been unfairly punished or are poised to benefit from shifts in the global supply chain. How should investors respond? So, what does this mean for you as an investor? First, it's crucial to assess your portfolio's exposure to China and sectors that could be impacted by its economic slowdown. Diversification is key here. Spreading your investments across various sectors and geographies can help mitigate some of these risks. It's also essential to keep an eye on macroeconomic indicators and earnings reports from companies with significant exposure to China. These can give you insights into how severe the impact might be and whether it's time to adjust your investment strategy. While the situation in China might sound alarming, there are also opportunities to consider. For example, companies that provide alternatives to Chinese manufacturing, like those in India or Vietnam, could see increased demand. Additionally, sectors like healthcare and consumer staples might remain relatively stable amidst this turbulence. Lastly, central banks around the world are closely monitoring the situation and could step in with stimulus measures if things worsen. In conclusion, while China's economic slowdown is a significant development that could impact global markets, it's essential to stay informed and not react hastily.